Brad Williams, Frugal Finance, cash flow from owning versus leasing. Up to this point, we've been grappling with a couple of closely linked decisions. Firstly, there's the question of whether our company should broaden its reach by investing in additional office space. Second, there's the matter of how to finance this expansion. In our analysis so far, we've crunched the numbers under two different scenarios for covering the cost of the extra space. If either of these scenarios yields a rate of return that meets our investment criteria, then it seems logical for us to proceed with utilizing the space. However, not necessarily a given that the risk and return should be identical for each financing option. Take, for instance, the scenario where we own the space versus leasing it. While both involve utilizing the same building with identical sales potential and non-real estate related expenses, the decision to own requires an additional equity stake in the property, which leasing does not. To delve deeper into the disparity in equity investments and its implication for owning versus leasing, we need to examine the variance in cash flows to the company under each option. Table 16.3 lays out the after-tax cash flows for both leasing and owning scenarios and calculates the difference between the two. In the initial two columns of Table 16.3, we reiterate the calculation of after-tax cash flows for owning and leasing, respectively. This represents the cash flows that the company would generate from utilizing the office space under each alternative. The 431 initial outlay in year zero now constitutes solely the equity invested in the property. Over the first 15 years, the after-tax cash flow would amount to $241 annually if we own the space, compared to $196,000 annually if we lease it. Got that? So there's going to be a net difference of $45,170 per year. If we opt to own the project, the $1 million cash flow from the sale would accrue to the firm. Crucial to emphasize that when weighing the lease versus own decision, the volume of sales and associated operating costs will remain constant regardless of whether the space is leased or owned. Therefore, the decision should hinge solely on the disparity in cash flows between the two alternatives. Put simply, whether we own or lease a building should not impact XYZ's business operations in any way. The discrepancy is illustrated in column 3 of table 16.3. As demonstrated by opting to own rather than lease, XYZ stands to save $451,000 per year after taxes. Additionally, if we own the space, XYZ stands to receive $1 million and some change at the end of the 15th year. Here's just the normal process, simple pro forma. And then we have this internal rate of return at $13.79. Then we have these proceeds. So the rate of return from owning versus leasing, let's go over the numbers again. Remember, the equity investment needed for ownership sits at $431. Considering this investment alongside the additional cash flows of $451 annually and $1 million in year 15 for owning versus leasing, the after-tax internal rate of return is 13.79. Whether this justifies the extra investment in ownership over leasing boils down to the opportunity cost and risk tied to investing equity capital in the property. If XYZ deems that a 13.79% after-tax return isn't enough to offset the risk linked with owning the space, then leasing might be the better option. Conversely, if XY believes that 13.79% is reasonable, given the risks with owning and eventually selling the property after 15 years, then ownership might be the way to go. Brad Williams, Frugal Finance. Thanks for watching.